Well, hello, friends, and welcome to this reading on stock-based compensation and post-employment compensation. So, as the title suggests, there are two major themes here. One is stock-based compensation, the other one is pension accounting. All right, so employee compensation can be straight salary, bonus, or it could be equity-based compensation, stock-based compensation. The major reason why stock-based compensation is advocated as a compensation mechanism is because it supposedly aligns the interest of the owners, the stockholders, to those of the managers. So the managers, being now rewarded with stock, will be more motivated to essentially do everything they can to increase the stock's price, which benefits the owners, the stockholders. Additionally, stock-based compensation reduces cash outlay, so there is no cash payment if it is made in lieu of cash salary. Now, the disadvantage of stock-based compensation is it is not a free lunch. It results in dilution of EPS. Why? Because more shares will be outstanding, and we'll talk about that in a little bit. Also, stock-based compensation, with all its merit about reducing agency prom, need to recognize that many employees really have no control over stock price, and therefore their motivation is not really going to align necessarily with the performance of the stock of the company. Also, for options, because remember, options have asymmetrical payoff. And because of asymmetrical payoff, only the upside is what the employees are concerned about. So if they increase the volatility, they don't suffer the consequences of any downside, any negative outcomes. Only the upside is what they enjoy. And so it essentially incentivizes excessive risk taking on the part of the executives. All right. In addition to stock options, there are something called as restricted stock units. And main key attribute is, they are exchanged with regular shares upon vesting, but until then there is no dividends being paid. Now, stock options are expensed based on the fair value on the date they are granted to the employees. Now, that amount, the grant value, is amortized over the service period, also known as the vesting period. So between the time it is granted to the time it vests, it is equally amortized, so in equal installment periodically per year. Now, this expense recognition used to be it did not actually get expensed all the way until mid-2000s and heavy lobbying by tech firms. Why? Because they don't want that expense to show up on their financial statements. But it is genuinely an expense, so it is required under both US GAAP and IFRS to be expensing stock options and stock-based compensation. Now, this recognition of expense lowers the reported earnings of the company because it's just like any other expense, even though it is not paid in cash. It will, therefore, reduce the retained earnings. Remember, net income goes into the statement of retained earnings. However, the corresponding entry in accounting for stock-based compensation is it will get credited to the share-based compensation reserve, which is part of equity. So think of it as essentially reducing one pocket of the stockholder